Understanding Management Accounting, Managing Cash Using a Cash Budget. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our email address and our phone number. You'll see our website and our YouTube page at the end of the presentation. I want to open this discussion with the operating cycle, which deals with how cash comes in and out of your business. Think about the Levi Jeans factory. You spend cash on materials and labor. You buy denim, you pay workers, you buy equipment. You manufacture a good or perform a service. So you make the blue jeans, you deliver the tax return, you give the legal advice, whatever it might be. When you deliver that product or service, you bill the client. And after billing, you collect cash so that your payments may not come in immediately. And after you collect cash, you repeat the process. That is, you go out and you buy materials and labor again, and the whole thing starts again. So that is the cycle, the operating cycle of business. I'd like you to think about one other concept, which is you put all this cash into your business at the beginning, and now a lot of it's somewhere else. Where did my cash go? The answer to that question lies in the balance sheet, the asset section of the balance sheet. Because your cash in almost all businesses is tied up in one of two areas, or both. First of all, your cash is tied up in receivables, money that you are owed from sales of products and services. And if you're a manufacturing business, you're also going to have money tied up in inventory, goods waiting to be sold. Now, both those areas, receivables and inventory, affect sales. They're related to sales. And a word of caution. Sales increasing with collections, the rate that you get your money in the door decreasing, creates a cash drain. And sometimes it's to the point where a business can't operate in the next month, the next quarter, because they're simply collecting cash too slowly. They're putting out a lot of money for product and services. They're delivering it, but they're getting paid too slowly. I want to go to an example of a cash budget. So this is my Levi example from July 1st of a year to September 30th of a year. So we've got a beginning balance in cash, July 1st. In brown, you'll see that we have taken out a loan, and we're going to use the loan dollars, and we're going to pay them back. So we take out a $200,000 loan. We use it to pay off our payables balance, accounts payable at June 30th. We buy some equipment, and then at the end of September, we're going to repay that loan, $200,000, and we're going to incur some interest, 8% for 3 months. So the brown on your chart represents the loan payable information. We sold some things in July, August, and September, but we don't collect the cash immediately. It says here, for example, that we had a $160,000 receivable balance at June 30th. We collected some of it in July and some of it in August. Starting with July, it says here on the right that we collect 80% of our sales in the month following the sale. So in August, we collect 80% of our July money. In September, we collect 20% of the sales in the second month following the sale. So in September, we collect 20% of our July money. So our July sales get collected in August and September. Likewise, our August sales get collected 80% in September in blue, and the remaining 20% in October, which is beyond the area of analysis we're doing. So the issue here is that not all of your sales come in cash in the month you're selling them. Instead, they come in the month after and the second month after. So you can see we've got some coding here, green, red, blue, explaining sales for the different months and when the money is collected. Now, realizing that the 120 and the 40 is not 80 and 20%. They just represent how you collected these receivables from June. Those are monies coming in the door, positive numbers. Now we have some negatives. We have some costs of sales, the direct materials, labor, etc. to make the jeans, and we're saying that 65 cost of goods sold represents 65% of sales, and that we pay that money in the month following the sale. So in August, we're paying 65% of the July sales. In September, we're paying in blue 65% of the August sales. Likewise, we've got operating expenses. You might see selling, general, and admin. So this is salaries for home office people, utility costs, costs that we cannot tie directly to a product. So in August, we're paying 8% of the July sales in the month following. In blue in September, we're paying 8% of the August sales, which is the month following. So what we end up here is we have a beginning balance for each month, we have inflows, we have outflows, and we have an ending balance in cash. So the ending July cash balance is the beginning balance in August, and the ending August balance is the beginning balance in September. And so you can see how it carries over from the prior month and how it all rolls through. Now here's a homework question for you. And again, you can pause, rewind this video to pick up the information that you need to answer the question. You can email me at my email address listed here and at the end of the video to get the answer. What would the results be if we collected 20% of our sales in the first month following the sale and 80% of our sales in the second month following the sale? So we're getting our money much later than we were in the first example. And also, what would the results be if cost of goods sold and operating expenses were paid in the month that you made the sale, not in the month following? Take some time and figure that out. And again, you can email me at the email address shown here. That's the end of part 7. You'll find 8 on YouTube soon. Our YouTube channel, Ken Boyd STL, all one word. You can register for live tutoring and one-on-one chat sessions at our website. You'll also find a complete list of our videos on the homepage, stltest.net. Here's our email address where you can email for the homework answer and our phone number. Thanks very much, and we'll see you next time.